This video will look at the reporting of investments in financial statements. For purposes of valuing and reporting, debt investments are classified into three categories: trading, available for sale, and held to maturity. Trading debt securities are securities or investments that companies hold and they intend to sell them in a short period of time. That means they buy and sell them frequently. These type of investments are reported at their fair value. Any changes from their original cost, because recall we record them at their original cost. If that original cost changes because the fair value changes, the changes are reported in the income statement as unrealized gains or losses. For trading securities, costs and fair values for investments of ABC were seen in this example. Two debt investments totaled $140,000. The fair value of those investments at the end of the year were $147,000. There was an unrealized gain of $7,000. When they bought them, they recorded them at $140,000, but their value has gone up to $147,000 in total. It is unrealized because they haven't actually sold the investments to realize the gain. But the fair value of those investments mean they have an unrealized gain. An adjusting entry would need to be made to record that unrealized. We would debit the fair value adjustment account for trading of $7,000 and credit the unrealized gain for $7,000. For available to sell securities, these are securities that are held with the intent of selling sometime in the future. They're not a trading security because they're not actively traded, but there is the intent to sell them in the future. These type of securities or investments are classified as current assets or as long-term assets, depending on the intent of management, whether to hold on to them for the current or the long term. They are also reported at their fair value. The changes from the original cost, instead of being recorded as part of income, they are reported as a component of stockholders' equity, called an unrealized gain or loss. So for example, if ABC had available for sale securities that had an original cost of $293,537, that's what they had been purchased and recorded in the general ledger for. Their fair value has dropped to $284,000. There is an unrealized loss of $9,537. It is unrealized because these investments haven't actually been sold. ABC would need to record an adjusting entry to debit the unrealized gain or loss of $9,537. This loss would be reported as a component of equity, not of income, and a fair value adjustment of $9,537. I'm going to go back a couple slides. Notice that this unrealized gain or loss on trading securities is a component of income. It is reported on the income statement. However, this loss of $9,537 is reported as a component of equity. It is not reported in net income for the year. Here we can see that net income on the comprehensive income statement was $118,000 on the available for sale securities, and the unrealized loss of $9,537. If we are working with equity securities, recall that any holdings of less than 20% are reported at their fair value. The unrealized gain or loss is reported in net income. Dividends, gains and losses from sale all affect income. For holdings between 20 and 50%, we accounted for them based on the equity method. There are no unrealized gains or losses. We report our share of the investee's net income. If we have holdings of more than 50%, we consolidate. Unrealized gains or losses there are no other income effects. In equity, here's the cost and the fair value of investments of Shelton for the year ended December 31st of 2020. we would need to record an adjusting entry in the amount of $1,800 for the amount of the gain. Fair value adjustment of $1,800. The unrealized gain would be reported in income. In the balance sheet, we would determine whether investments are short-term or long-term depending on their intent and whether they are readily marketable. If they are readily marketable with the intent to sell and they are intended to be converted into cash within the next year, we would classify them in with short-term investments. But if the investments are not readily marketable, ready to sell, with the intent to sell them, they would be classified as long-term. Here we're seeing under current, the debt investments reported at their fair value. These are short-term. These are with the intent to sell. These long-term debt investments reported at fair value, stock investments that were reported at their fair value, and stock investments at equity. These would be the cost method stock investments, and here we would have the equity. Here we have the equity method with significant influence. These are short-term, these are considered long-term. Here is a summary of how we handle the other revenues and gains. Interest revenue, dividend revenue, gains of sale of investments and unrealized gain, and other expenses or losses related to investments, losses on the sale and unrealized losses. Unrealized gains or losses on available for sale securities are reported as a separate component of stockholders' equity. So here we're seeing that they're not reported as part of income, but reported within equity. Accumulated other comprehensive income is reported as a component of stockholders' equity. So if we have an accumulated other comprehensive income, it is not reported in income, but as a part of stockholders' equity. So here we're seeing a partial balance sheet.